It's your boy Warren B. And I was checking out some articles in Men's Health magazine. This is the July-August 2012 Men's Health issue. And I generally like the pictures in magazines, which is why I gravitate towards them, being a creative person. I generally don't really care too much about the articles. I ain't gonna lie, I rarely read articles in magazines, but I love magazines. And but I get ideas from the pictures. When you're a person that's in tune to your own subconscious, most people aren't there simply directed in many ways, none of which are of their choosing. But when you grow in consciousness, then you learn to direct your own thoughts, control your own moods and feelings. Most people are nowhere near that. But I was reading an article in this magazine, and it is Rich Habits. We ask advisors how their wealthiest clients got that way. Okay? And the information that they give here is all bad. Now, these are advisors. These are top players, you know, supposedly in the game. But it's interesting because generally the information that you get, be it on a television program or how an interview is conducted, is based upon who the advertisers are. Advertisers are not going to support a program that's based upon information that opposes what they're selling. I can tell right now from reading this that the key people involved in this were educated in a faulty American system, which most of us were, and who are largely directing people in a direction that the establishment would want the average goyim or dumb sheep to go in. Listen to what they say. Number one, go shopping, sort of. The reason many of us aren't getting rich is that we follow crowd logic, not our own instincts. People have the opposite psychology when they invest than when they shop for clothes, says David Kudla, CEO of Mainstay Capital Management. If they see an item at half off and they like it, they buy it. With stocks, people wait until prices are up, and everyone feels great. If you like the stock when it's low, go for it. My main problem with this is, number one, and as you'll see in all of their great and grandiose advice, they're all leading you in the direction of what are known as paper assets. Paper assets, stocks, bonds, mutual funds. These are the items that make up what are known as a diversified portfolio. But that's not diversified, because there's no mention of real estate. That's an asset. There's no mention of gold or silver. Those are assets. There's no mention of owning businesses. Those are assets. You see what I'm saying? Things of that nature. These are all talking about one particular area of investment called paper stocks. Now, the thing about paper stocks is that the tax on paper stocks, or what are known as capital gains, is about 20%. What's interesting is that when you go to work and punch the clock, you're taxed at almost about 50%. So what am I saying? I'm saying the first thing that you need to consider when making an investment or financial move is, what are you taxed at? Where's the tax level or bracket? That needs to be a part of your decision-making process. And this is why if you have the ability to start a business in these volatile economic times, it's less of a risk than counting on a job and somebody to keep you employed. It's less of a risk, actually, because number one, you're taxed at almost 50% of what you earn. This is interesting too. I'm gonna try to keep this video short because I love information. I was talking over the Labor Day weekend, or whenever that was. I was talking with my grandmother, and my grandmother, you know, she grew up in the South, and this is interesting because anybody can learn from this. She was talking about sharecropping, and I didn't know a lot about sharecropping. I really understood what they really meant when they said sharecropping. You really are sharing the profits 50-50, just like you do at a job. So really, a lot of people will look at black people and say, well, you know, they came from humble beginnings. But look, if you look at yourself, you're no different than a modern day sharecropper with a job, because half of the money that you earn is for someone else. You earned it, you did the labor, but somebody else shares half the profits. That's a sharecropper. You're no different than my grandmother. My grandmother said they worked the land. First of all, the land, the white guy owned the land and the house. So great granddad, they called him Big Daddy. He worked. He struck up a deal with the owner, got in the house to work, and everyone worked the land, the crops, the cotton, and it was 50-50. One pail went to the family, one pail went to the owner of the house, and that was how they split it, 50-50. I think she said pail, and that's how they split it. Well, when you work a job, you have 3 slave owners. The owner of the business that you work for, IBM, Xerox, Office Max. You work for the owner of the business that you work for. You work for the bank, okay, that owns all of your debt, your mortgage, your college, all that payments, all that stuff. And then you work for the government through taxes. You got 3 slave owners. In a lot of ways, you're worse off than my grandmother was back when she worked as a sharecropper. But you have the illusion of being at this level or that level. Well, I make $100,000 a year. Yeah, well, damn near half of that's taken. You got 3 plantation owners. 3. See, what you need to understand is that the game simply changes form. But the game, the impetus behind the way it's set up is the same. That's the part you need to understand. They simply change strategy. They don't change their heart. Their heart doesn't change, just the strategy changes. So that's one of the issues that I have with this, is the taxation of paper assets, or which is in the capital gains area, is about 20%. Now it's not as much as when you take when they take taxes and for earned income, which is when you go to work. But the problem with stocks is that you put up 100% of the money, you take 100% of the risk, and you only get 20% of the gains, if there's any gains, whereas the fund manager gets 80%. 80-20. 100% of the risk, 100% of the money on your end, but you only get 20%. That's bad financial advice. Second, build a pyramid. You're the pharaoh, and your investment portfolio is your pyramid. Build it up steadily over time and limit your risk to the very tip. The top 10%, says Scott Tyrus of Tyrus Pennington and Associates. That's the money you can throw into hunches and instincts. Everything else should be in well-managed mutual funds. Jesus, that's spread investments over dozens of stocks. Mutual funds. Do you see a similarity? Both of which, mutual funds here, stocks here, both are paper assets. There's nothing diversified about any of this. This is information for people who want to play it safe. The problem with playing it safe is that you become an easy target. Parking your money is almost as risky as gambling it at a casino, because when you park your money in some vehicle, it is largely based upon the monetary system that you are in to stay intact and in place. The economic system in America is absolutely too volatile to count on that. Bottom line, we have a currency. We don't have money anymore. We have currency, and it's not backed by gold or silver. None of these things are talking about investing in commodities, which is really along the lines of hedging, but we'll deal with that in one of these other ones. But mutual funds, again, 20% on the tax side, safe investment, but again, it's no different than a 401k. The 401k came into place with something known as the ERISA, Employee Retirement Income Security Act. And ERISA was passed, I think, in '71. But you can do some research. Go to Google and type Employee Retirement Income Security Act. And that was passed so that the rich companies, Ford and places like that, did not have to guarantee you the $3,500 a month that they promised, or whatever it was. They simply changed the responsibility of your retirement over to a fund manager, which is what these people are. And now, instead of counting on a specific amount, a fixed income, you're dealing more with the stocks. 401k is just a glorified stock portfolio, which is not diversified as paper assets. And so your retirement is based upon how well the stocks do. That's not good financial advice, period. It's good for people that want to play it safe, but you're better off betting on playing darts. See, the target on a if this little red dot was the target on a dartboard, at least the target is stationary. It's in one place up against the wall. But in the stock market, it's up and down, it's this and that, and this, you know, you're trying to throw a dart at a moving target. You don't know if it's going to go up or down. Nobody can promise you that. It's for people that want to play it safe. That's just not good financial advice. Not in this volatile time, where the true buying power of $1 today is 8 cents versus $1 back in 1913, because your dollar's not backed by anything anymore. It's no more than monopoly money. Okay, now let's see the next one. Maintain, then gain. Once you have some wealth build up, protecting it becomes as important as accumulating more. Instead of investing in the next big vaccine or computer breakthrough, allocate more of your assets to CDs, bonds, and treasury securities. Says Tyrus. Once you've pulled together a decent portfolio, start subtracting your age from 100 to determine what percentage should be invested in stocks. in China, they showed Asians in a store that sell gold, pure investment gold, not the little 10 and 14% gold, or what, 14K and 10K and that. They're in a store, bunches of Asians, bunches of them. I seen it on YouTube, buying coins in Asia, because they're getting a real education over there, folks. You're not over here. The average Asian invests about 30 to 35% of their income. The average dumb American, about 2%. And this is what they're telling you to invest in, all in paper assets. That's bad financial advice. I don't care where you got your degree from. I'll use that degree to wipe my ass when I take a shit, because the paper that the words were printed on, you know, are no different than the paper on this sheet. This is, you see what I'm saying? This is 8 cent on the dollar. Is about what the buying power of a dollar is in 2012 versus 1913 when it was backed by gold. Okay, so again, CDs, bonds, treasury, again, this is all paper assets, and it's really advice for people that want to play it safe. But this is about supposedly rich habits. Rich people know the importance of something that none of these things are telling you. And I wish I had a, let me see if I could find yeah, let me show you this. Just took a pen out of my, watch this. What's that say? None of these things are teaching you the importance of this property. If I buy a silver stock or a gold stock, it's no different than this stuff, but I only own the paper. I don't want to own the paper. I want to own the asset. I want the coin in my hand. I want to own it. I want property. The rich people know the importance of this word right here. You got an idea, own it, and then sell it. Taking your ideas and turning it into this. Taking your ideas and turning it into this. Focusing on property. I'm not talking about just real estate. It could be copyrights. It could be trademarks, a brand name, you know, anything in the form of property. That's the key. None of this is talking about the importance of property. When my grandmother worked that land, she was working the property of the white man. Property. That's something that they're not teaching you. This is how you get rich. Understand the importance of property. Not, see, if you invest in a stock, you're investing in somebody else's what? Property. See how it's already underlined? Property. Keep that in mind. Next. Run toward fire. Hold on to the kayak, no matter how rough the financial whitewater becomes. Historically, declines have always turned into recoveries. Jump on a few stocks that seem to be in distress or that are being abandoned by other investors, says Stephen Cassidy, President and CEO of Cassidy and Company. So run toward a few fires. That's where the opportunities are. The only thing I agree with this here is that whenever there's a recession or depression, that's where your new group of millionaires are born. They're always born out of recessions. The people that understand the game and figure it out. Okay, they're telling you to invest in somebody else's property and then just cross your fingers and thank God or Jesus that it's going to turn up. The problem is you're counting on an already insolvent economy. China is kicking America's ass. Almost everything in this house has a made in China sticker on it. You see what I'm saying? So these are things that you need to understand. Here's a pair of scissors. What's that say? Stainless China. Do you see what I'm saying? Almost everything. This pen probably came from China. You see what I'm saying? America is the largest debtor nation in the world. China is the largest creditor nation in the world. Why is this bad? Why is this bad advice? Because it's telling you to count on a debtor nation to turn things around. The largest debtor nation in the world cannot turn things around until they become a creditor. And the largest creditor nation in the world is China. There's no turning that around unless you become a creditor. It's kind of difficult to make a product, something as punk ass simple as a pair of scissors, when you can get them for 20 cents or 50 cents per scissor and sell them for $2.50 retail in America. It's kind of difficult to fight against that when it might cost you $2.50 per scissor to get it made in America. Who wouldn't go where the emerging markets are and get your products that you sell made cheaper? Who wouldn't do that as a business person? Yeah, it's things that's China doing that they're doing on purpose. But I don't blame them. Would you, if you were Chinese? We wouldn't even be having this conversation if you were Chinese. This is all bad financial advice. And the most important thing you need to remember is property. This is Warren B. I'm out.